Good morning, everyone. This is Sakhalin Reports of Maynard Casterison. To my right is Christian Whitehead of CG Financial Services. We want to thank everybody for listening in to our webinar here today. Christian and I's contact information at the bottom of the first slide there. So if there is anything that you have that you want to ask that we can't get to, feel free to contact us at any time. So with that, we'll get started here. Christian and I got together a couple months ago and wanted to go over a few employee benefit items in regards to plans. I had an opportunity a few months ago to go to the National Conference for Employee Benefit Plans. There's a lot of discussions from the DOL side of things on findings and concerns, not only from the plan sponsor side, but including us as CPAs and auditors. So we have a few items just to kind of go over to help improve the industry. And then Christian's going to take over and discuss the impacts of the new fiduciary ruling. So with that, I'll kick it off here. Again, my name is Zach Skriniars. I'm with Maynard Casterison. I've been with Maynard just over 9 years now. I'm a CPA with the firm. As a firm in general, we pretty much audit over 60 plans, ranging from 401ks to defined benefit plans, a few health and welfare, a few ESOPs, and a couple others along the way as well. I have experience over the past 6-7 years of auditing those types of plans as well. Again, mostly 401k plans, but I have audited a few defined benefit plans and a few health and welfare. The overall goal from my side of things is to go over some key areas that the DOL has found that could use some improvement amongst plan sponsors and plans in general, and things that as they've gone out and performed their own audits, areas that they feel like can be improved upon. And so I pulled a few of those out and wanted to discuss those in a general fashion, more of an oversight. Obviously, every plan is different. Every plan is run differently as well. And so this is kind of just an overview of some of the areas that they felt could use improvement. The goals there, the items to discuss, as you can see on the slide, are just reasons for an audit and why plans need to have an audit, the types of audits that are out there, the difference between a limited and full scope audit, the role of the plan sponsor, which I'm just going to touch briefly on. That's where Christian's going to come into play and discuss a lot of the fiduciary responsibilities of a plan. The bulk of my presentation will be, again, in areas that the DOL feel there needs to be some improvement. And then finally, a little piece on non-attest services, which probably impacts more us as auditors, but things that you as a plan sponsor to be aware of. All right, so start out here, reasons for having an audit. For those of you who do have an audit, you probably are aware of this. For those of you that don't currently have one, this is an area to keep an eye on. Typically, you need to have an audit when you have 100 participants at the beginning of the plan year. This triggers requiring filing a large plan, Form 5500, with a Schedule H. That 5500 then requires audited financial statements. One of the big key takeaways in understanding this requirement is understanding the definition of a participant. A participant is someone that is eligible to participate in the plan. It doesn't necessarily mean that they are participating, but the fact that they are eligible. So understanding in your plan document what eligibility requirements you have are is very key. Typically, it's being 21 years old and having 1,000 hours of service, but some plans out there vary. So understanding what that eligibility requirement is about. This also participants does include terminated employees with balances as well. So a big misconception is that a participant has to be an active employee. That's not necessarily the case. You'll see the example I have down there as just a way to identify if you have the 100 participants. The example there is you have 50 employees deferring, you have 35 that are eligible but have elected not to defer, and then you have another 25 that are terminated but they have balances. This is 100 participants, and in that case it would trigger needing an audit. So just things to be aware of and things to look at. It's not necessarily, again, just active participants in the plan. So understanding your eligibility requirements. Plans under 100 participants can fill out a 5500 for small plans. There's the short form and there's an easy form. There is a little bit of an exception as well in terms of if you were to grow over 100 participants but had previously been below that threshold. You'll see that there in the third bullet, or the fourth bullet point, excuse me. that if you had previously filed a small plan 5,500 and you're between 80 to 120 participants at the beginning of the next plan year, you do get a grace in which you can fill out the previous 5,500 form that you had. There are some exceptions. There's 3 exceptions to that small plan rule. I'm not necessarily going to go over those at this point in time. If you have further questions on that, again, feel free to contact me on that. You can continue, though, to fill out that previously filed 5,500 until you get above the 120 participants. Once you have reached that, you will then have to fill out the large plan. You will have to have an audit. You won't be able to come back down from that until you are under 100 participants again. So just some information there and things to be aware of in regards to what type of 5,500 you need to file and whether or not you need to have an audit. Moving on, the different types of audits that are out there, and the stress point here is you as a plan sponsor get to elect whether or not you want the limited scope or a full scope audit. A limited scope, though, you do need and are required to have a certification from a bank, a trust company, or insurance company over certifying the investments in the plan. That certification must state that it is complete and accurate information, and it must be a signed certification from that institution. Ideally, what the limited scope does is it allows us as auditors to, and I guess you as plan sponsors, to not have the investment portion of the plan audited. That also includes investment earnings on those investments. So it's a lot less work that we have to do, but because of that, and something that kind of strays plan sponsors away from having the limited scope audit is we do not and we cannot opine on the statements themselves and the audit themselves. Investments are the largest part of any plan, and when we're not auditing that and looking at that information, it's hard for us to place any sort of reliance or opinion on that. We do have to give you a disclaimer of opinion, so sometimes that will stray plan sponsors away because they don't want an audit report that doesn't have an opinion to it. In that case, that's where you would have a full scope audit, and we would actually test the investments and the earnings, testing valuation of those investments, existence, completeness of those investments, and then also performing some audit procedures over the earnings. So a little bit of a difference there. I think, again, the main item from your standpoint as a plan sponsor is that election does come from you. You tell us as the auditors what you want, and that's what we come in and perform. As mentioned, just to discuss the plan sponsor's role a little bit, and again, Christian's going to discuss a lot to have to do with the fiduciary responsibilities of the plan, but overall, you as plan sponsors need to obviously have your participants' best interests in place, and to continue to monitor your plan, reviewing plan reports. A lot of things are electronic now. Getting on frequently to your service organization's website to review plan reports is very important. Another area or an idea is to have a plan committee that meets once a month to go over investment performance, the review of the plan, fee benchmarking, things of that nature, to continue to make sure that your plan is operating the most effectively for your participants, and just always having your participants' best interests at the forefront. So again, I'll have Christian kind of continue on with that. All right, bulk of the area here now, the DOL Areas of Improvement. Just a little bit of background, the DOL has been performing audits over plans. They've been finding various issues, not only with plan sponsors, but with various audits out there as well. So again, we're not by any means excused from any of these issues. So again, all of us working together to try to improve the industry is the goal of some of these items here. And to start off with, I have a few, and it's mostly just all based upon understanding your plan document. Plan documents, you usually have a full-fledged plan document that 80 to 100 pages, even maybe more than that, and then you typically have a summary plan description, which is a condensed version of the full plan document. Making sure that you're reviewing both of those documents, making sure they're in sync with one another. Plan documents can be amended at various times. Sometimes plan sponsors forget about updating the summary plan descriptions over a period of time. So making sure that those two documents talk to one another, and making sure that all the information in there is correct and accurate. A key area is the definition of compensation. Really understanding in your plan document what the definition of compensation is for your plan, what's included and what is excluded. Pretty common example is typically bonuses paid are excluded from your compensation in regards to what your participants are deferring on. And so understanding that and understanding that definition as it is written in your documents is extremely important. You can also monitor this by reviewing payroll periodically to make sure that calculations on the deferrals are accurate and based upon what your true definition of that compensation is. Us as auditors, we perform payroll testing and we perform participant deferral recalculations. So we're constantly inquiring on what your definition of compensation is for the plan so that we can calculate those deferrals accurately ourselves. Another key area, and this is just kind of plan management, is tracking the deferral changes and making those changes in a timely manner. Again, everything is electronic now, so a lot of participants are going online and changing their deferral rates. John Smith could change their deferral, over the next 8 pays 8 times. Now, I know there's some plans that might not allow you to do that, but again, just things to be aware of and making those changes as necessary. If you have a 2 payroll period wait time until that gets changed, making sure that happens, that change is happening on the 3rd pay. If it's an immediate change, making sure that's taking place and that your people in payroll know that the changes on deferrals were made by an individual. So again, maintaining that documentation and any deferral changes, your service organizations, your TPAs are probably sending you information on changes. So I don't think this is a huge area of risk, but just being aware of that and making sure you're continuing to track that is very important. Other areas of the plan document, you want to make sure you're understanding your policy on loans. A lot of policies out there is understanding that you can only have 1 loan outstanding at a time. There's typically a time frame to pay back, and some plans even have you stop deferring for a period of time until most of that loan is paid back, if not all of it. Having payroll deductions to help pay back that loan as well, making sure you're understanding what your policy is per the plan document. Another large area that DOL is hitting on is hardship withdrawals. Hardships are obviously for financial reasons. Someone is in financial distress, and so they request a hardship withdrawal. There has to be supporting documentation behind that hardship, and the DOL is high on maintaining all that information and having that readily available in case they were to come in and audit, or even if you're having an audit, us as auditors need that information to support that hardship. The other area for that as well is making sure that that participant is no longer deferring for at least a 6-month period of time. Again, following your policy in the plan document, very important, especially on the hardship side of things. And just in general, I guess in distributions, to wrap up understanding the plan document. So just understanding your policy on distributions, your policy on vesting, your policy on forfeitures, making sure that all that information in the plan document is available, making sure you're following that information, making sure the forfeitures are being calculated correctly on distributions in which you might not have full vested interest in. And so again, just really gaining a good understanding of the plan document, making sure that you're updating it as necessary, and really following those policies in and out. The next key area I have here, which is an interesting to always talk about, especially when we come in for audits and to discuss with plan sponsors, is the timeliness of remittance. The rule out there is that as soon as employee contributions can be segregated from general company assets is when you should be remitting those into the plan. And so it really is as soon as you possibly can get it done, and that has to be consistent. There is an additional rule to that no later than 15 days of the month following the month the funds have been withheld. Some people misunderstand this as saying, well, I got 15 days to get that money in, and that's not the true case. It's supposed to be as quickly as you can segregate from general company assets. So if you're consistently remitting the funds each pay into the plan within 3 days, which I'm sure most of you, as a lot of this is electronic now, I'm sure most of you are getting that in within a day, if not 2. But being consistent in that, if you go beyond that, if you're consistently 3 days, but you had a 4th day or a 5th day, there is potential prohibitive transaction right there. You potentially have to calculate lost earnings on getting those funds in a day later than you normally do. There's a lot of, there's some question marks to that. Can be some discussions if you're having. If you do realize that you've gone beyond what you normally do, make sure you're having documentation. We've heard examples of reasons why it's taking longer. So there's definitely reasons out there. So just making sure you're documenting that. The flip side of that too is I have an example there, kind of says no good deed goes unpunished. We've had examples and heard stories where every pay you're getting it in within 3 days. Then I'll use John Smith again, the payroll guy. He has to leave for vacation for 2 weeks. He hustles and bustles, gets it in within a day. And then if the DOL comes in and sees that, they'll ask you, well, how come you're not doing that within a day every single time? So there are examples of that out there as well. So it's a fine line. It's a big issue amongst the industry. And so, again, just maintaining documentation for the days that you remit into the plan and just try to be as consistent as possible is very, very important from the plan sponsor side of things. The next area I'm going to go into are Sakhalin reports. This is really more, I guess, from the audit side of it, but there is an important piece for the plan sponsor out there. Sakhalin report, for those of you who are not fully aware, it's a report that an external or third-party CPA goes to your service organization and pretty much reviews the internal controls and audits the internal controls of your service organization. They provide it's a very, very long, detailed report. If any of you have read those, they go in, they test controls, and they make sure that the service organization is operating effectively. As you, as plan sponsors, put a lot of reliance upon them to properly, move the money and allocate the funds as necessary based upon your plan and your participants, it's very important that those service organizations have strong controls. We as auditors can rely upon the Sakhalin report since we are not actually auditing the service organization. It by no means allows us to not do audit work in various areas, but again, it just allows us to use them as some form of reliance. And so the key part to this and why I'm bringing this up as part of this presentation is you as the plan sponsor, there is a section in every Sakhalin report that relates to user entity controls. I wanted to bring in an example earlier, but as they are restricted reports, I didn't want to get anyone in trouble, so I don't necessarily have the example there. But if you were to look into your Sakhalin report for your service organization, you can typically do a search and search user entity controls. It's usually 7 to 10 pages of controls that you as the plan sponsor need to have in place in order to properly remit the funds over to the actual service organization. So key areas for payroll and moving the money around to the service organization. So these areas for the user entity controls are very important to gain an understanding, to read through. I'm not saying that every single user entity control will apply to you, but at least having someone who administers the plan review these user entity controls, to go through them and either document who does them, who has the ability to do the various controls and whatnot is very important. So make sure you're reading those as plan sponsors. Make sure you're identifying who's doing what, because us as auditors as well, not even the DOL, are going to come in and ask you those questions as well. So a very important tip there. The last slide I have, and it's another area that's pretty important, and again, a little bit more focused on the audit side of things, but you as plan sponsors need to be aware as well, are non-attest services. We as auditors, you might hire us to come in and perform your audit, and out of convenience, we might write the financial statements for you. This would be considered a non-attest service. The reason this is important because performing that non-attest service could impair our independence. And so it's been cracked down pretty hard in the profession in general of documenting that there are individuals running the plan or running the organization that have, we call it the skills, knowledge, and experience or expertise to take responsibility for the audited financial statements, even though we're writing them. So it's very important for you as plan sponsors to be aware and understand what those financial statements are stating, to make sure you're understanding not only just the numbers, but the footnotes as well. And at the end of the day, eventually taking responsibility for those audited financial statements. And so that way we can put reliance upon that. We can continue to write the statements for you. If we were to feel that we were unable to do that, or you were unable to take responsibility, we'd have to take a different measure because, as mentioned, we don't want to impair any sort of independence. So it's a kind of a hot topic. It's more for the auditor CPA profession to make sure that we're better documenting that information. But again, it's something for you as plan sponsors to be aware of because it's a very important area for everybody. That's going to be it for me on this. Again, my contact information was on the very first slide. Appreciate all your time, and as I'll turn it over now to Christian. Thank you.
Thanks, Zach. Good morning to everyone that's tuned in and listening. Again, as Zach mentioned in the beginning, we appreciate you taking some time. So I'm going to be talking a little bit more about the Department of Labor Fiduciary Rule, and specifically what impact it has on plan sponsors. This is something that really has been an ongoing process, and when I say process, from a DOL perspective, there's been talks and conversation around this rule and the regulations. Really, if you look at all of it, going back almost 5 years now, it started to gain some momentum, as we'll talk about, and really has now started to come to a point where it's being implemented. And again, it's very, very important to make sure that plan sponsors have at least a somewhat of an understanding of this. Again, with any legislation or regulations, we can get pretty deep into the weeds. So I just want to, make sure that from a informational standpoint, you have a good, just general understanding and takeaways from the information I go through today. All right, so again, just my information, a real quick introduction. Again, my name is Christian. I work with a firm in town, CG Financial Services. I've been an advisor with CG for about 7 years, and we've got offices, 2 offices in this area that would be considered our main offices, but we have locations throughout mid-Michigan and northern Michigan. We also have a location in the Chicago area, and then Richmond, Virginia, and Charlotte, North Carolina. Specifically, myself and a number of other advisors in our firm specialize in working with businesses and school districts with regards to their retirement plans, both on the ERISA and non-ERISA side, mainly the ERISA side. And that's kind of, at least today's conversation will apply mostly to that as far as the actual rules and regulations. But from a best practices standpoint, that can apply to all of those different entities. I have my accredited investment fiduciary designation, so that is something that people in my position as advisors that work a lot in this space with qualified plans, we take that very seriously. And as you'll see and as you'll hear, I'm going to use that word fiduciary quite a bit. So that's something that we take seriously because we know how important this rule is now and then moving forward servicing our clients. And as a firm, CG Financial approximately manages right around $300 million in qualified plan assets. That's really grown over the past couple of years with a lot of these regulation changes, but it's something that we've done from the very beginning of our firm, and we've again taken it seriously to make sure that the services we are providing are in fact in line with the regulations, as that landscape evolves quite a bit, as you know. So we want to make sure that moving forward we stay in the forefront of that. So really why you're all online is to learn a little bit more hopefully about this new fiduciary rule. So as I mentioned, this has been something that's been really an ongoing process from a legislative perspective. Anything that comes out regards to these rules and regulations doesn't happen overnight, and really when it does come out, it's not necessarily set in stone. So as I mentioned, it's an evolving process, but we've recently come to a point where we've hopefully reached a somewhat final regulation. We've come out with new and revised prohibitive transaction exemptions within this, and I'll hit more in depth on these obviously, but that final regulation really starts to glean out and tighten down on some of these what they call prohibitive transactions and exemptions. And throughout this process, the Department of Labor has come out separately with 3 frequently asked question, informational pieces, just because, again, as you know, this legislation can get pretty technical. They tried to bring out these frequently asked question pieces just to put it in more of layman's terms. And that started back in October of 2016 was the first set that came out. They came out with another one in the beginning of this year, and then most recently they've come out with one in May. But as you can imagine, as I said, with any type of legislation, there's usually people that oppose it. And this opposition came from both the private industry with law firms and then also from a political perspective, to where there was unsuccessful attempts to repeal this fiduciary rule, again, on both sides of that aspect. I think there was at least 9 or 10 private firms that came out and declared that this rule was too overbroad, potentially unconstitutional. Same thing from a political perspective, but again, both of those attempts to overturn the rule and repeal it were unsuccessful. are deemed unsuccessful. And as you know, beginning of the year, we came into a new administration as far as the president and his cabinet. Originally, this rule was supposed to be implemented in its capacity, full capacity, on April 1st of this year. Well, again, due to the new legislation, there was a movement or a action taken to delay this April 1st implementation date, just so that the rule could be reviewed in a new light according to the current administration's priorities. So that being said, after they kind of did their overview and review, some talk was that it was going to get repealed once the administration specifically looked at it. That did not happen. So as of June 9th, which we're obviously past that date, but as of June 9th, this DOL fiduciary rule is now applicable. Okay, so we're in it. We're in the point now to where if we're not aware of these rules and we're not doing things as far as processes and procedures to implement them, we're already behind the 8 ball. So what was the point of this, right? Why did the Department of Labor issue a new definition? And when I say new definition, the word fiduciary and the context around that's been in the ERISA code, really going back to its inception in 1975, right? But that was a different time. That was a different era than where we're at now. Obviously, there's been a lot of change and improvements, if you ask me, as it relates to the industry. But if you go back to when this first started, it was the world of the defined benefit plan, right? At least they were most prevalent. So this goes back to our parents and grandparents, to where their retirement was solely funded by their employer in the form of a defined benefit plan. 401k plans didn't exist, right? That defined contribution look and feel, that was few and far between. Obviously, as we moved down that spectrum of time, that's when they became most prevalent, or more prevalent. And is because of this, right? Because there was no defined contribution majority, if you will. The old rule, it was easy to avoid a fiduciary status, right? These service providers could really not apply much effort and still, not be in a position to where they were going to be considered a fiduciary. So the Department of Labor, their whole thinking was, we want to make sure that we kind of sweep a lot more of these organizations under the rug of that fiduciary definition, right? They want to tighten up the rule to make sure that a number of these service providers, and I'll go through in a little bit specifically what those service providers or who those service providers are. But the intent of the rule is to protect and make sure that these employers and their employees are being serviced and treated in a manner that's consistent across all platforms, right? It broadens the population of service providers that must adhere to this. And essentially that just means these service providers have to put the client and anybody that's engaged with them in a service capacity, they have to put their best interests before, ultimately the bottom line or their own pocket. So what does the new rule provide, right? So essentially, what is the classification or what is the stipulations that would determine if the service provider or yourselves as plan sponsors are fiduciaries? Well, under the new rule, there's kind of two prongs to this. You're considered a fiduciary under ERISA if any of these service providers make a recommendation to a plan sponsor fiduciary. So an example of that, and Zach talked about it a little bit, many of our plan sponsors and many organizations out there that have a qualified plan, hopefully as a best practice, have a plan committee that would be considered a fiduciary from this perspective. And then also participants, right? So it's not just from a group level. It goes down to participants, and I would say that's probably more important, because again, if there's advice or consultants give any type of recommendation to participants, that's affecting them in the long run in the form of retirement, right? So again, making a recommendation to a plan sponsor, fiduciary, or plan participant, and that can both be on the qualified plan side, or this rule also applies to individual IRAs. So where that comes into play, just as an example, if someone's getting ready to retire from a organization and let's say the advisor that's working with the plan starts to lay out specific recommendations to where maybe this participant can roll their money out outside of the plan into a separate IRA, into separate investments, that's going to be criteria to then mark that advice that consultant a fiduciary. So this isn't just applicable to the qualified plan side, it's also applicable to the IRA side as well. So any qualified money, these rules are going to overlap. So that's the first prong. The other prong is if those first bullet points are done and they're receiving a fee for doing so, again, that's where you're going to be considered a fiduciary, okay? And again, we can get pretty technical. We can really dive down into that point, but I'm just going to be general in this presentation. So if you have someone that's involved with the plan, that's making a recommendation, and they're receiving a fee for doing that, from a broad perspective, most likely they're going to be considered a fiduciary under this new rule. So one of the key words there is make a recommendation, right? So what's considered a recommendation? Well, a recommendation according to this rule is any communication that can be reasonably be viewed as a suggestion that a recipient take or not necessarily take a course of action, right? So in the most basic form, it's a call to action. Now, whether the participant doesn't or doesn't do it, the point is that if communication is given, that's going to be under the criteria or under the umbrella of a recommendation. And the Department of Labor specifically says that, determining whether it's a recommendation or not is going to be more of an objective rather than subjective type of analysis, right? The more tailored that the advice is, the more likely it's going to be viewed as a recommendation. So, an example of that is, again, go back to my previous slide to where I talked about someone who's giving specific investment advice about a rollover out, from the plan out into their own IRA. If someone provides a list of specific securities and says that, this is appropriate for you, that's obviously a recommendation, okay? So again, the interpretation can be kind of looked at from a number of different ways, but essentially if you were to kind of flesh it out and take it for what it is, if there's any type of call to action and whether they take it or don't take it, that's considered a recommendation. So, very broad, right? So it's going to cover a lot of potentially communications, both between the plan sponsor and then also to participants. So. Right, so what isn't considered a recommendation? Okay, so if you're worried about, well, again, we talk to our participants, service providers we engage, talk to our participants. What isn't considered, a recommendation? Well, recommendations made to an independent plan fiduciaries with financial expertise, right? So this essentially says, any service provider recommendations that are made to fiduciaries independent of the advisor, right, that may not give rise to fiduciary status, but the caveat being that the independent fiduciary must possess, and I'm doing air quotes here, financial expertise, right? Financial expertise, typically, if someone wants to have that title or that connotation to their firm or their name, you've got folks that are what are called registered investment advisors, right? Or in other words, they manage more than 50 million in aggregate as far as from an asset management perspective, right? So a lot of firms out there that are considered to be fee-based typically will be registered investment advisors. Our firm is CG Financial is an RIA. And really to prove that, or to make sure that, again, they're complying, to prove that you can rely on written representation, right? So if someone puts in writing, which really in all cases you should have something in writing as it relates to any type of rule or regulation, you can rely on that writing or that verbiage that's given to then say, okay, you know what, that's, they disclosed it, it's transparent, any recommendations and communication will be considered a recommendation in that regard. Information that describes terms or operation of a plan, that won't be considered a recommendation. So as an example, plan sponsors have a summary plan description, right? That's going to kind of outline the different components and the different workings as far as specifically to that plan. One of those examples would be, minimum required distributions. So the fact that the plan and the summary plan description may state that you have to take them, that won't be considered a recommendation just because that's an IRS rule. But if you go to the point and someone starts to then advise how to invest that money, then you're back under the umbrella of providing a recommendation. Another example of that, to where it won't be considered a recommendation, would be any automatic rollovers of small account balances. So many plans have, just from a design perspective, have a caveat or a piece of their plan that says if you have, a minimum of 1,000 or 5,000 and you're no longer working at the firm, we're just going to automatically roll your account out. That wouldn't be, again, considered a recommendation. But again, if you start to then say, you know what, I'm going to provide you advice on how to invest that money specifically without some certain circumstances, then that again could potentially fall under the caveat of being a recommendation. So what else isn't considered a recommendation? Well, a request for a proposal. So again, as a best practice, we try to advocate, and I know Zach again hit on it in his piece. With our clients specifically, we look at every 2 to 3 years to go out and get a RFP, just to make sure from a service provider perspective, from a plan component perspective, we're in line with what the industry, based on demographics, would say is fair and reasonable. So any type of correspondence or action as it relates to that RFP and the responses, that wouldn't be considered a recommendation, right? As long as, so let's say I went out to vendor, ABC, and I said, provide me with an RFP on potentially what you would consider, an investment lineup on your platform. That wouldn't be considered a recommendation as long as they weren't providing, let's say, proprietary funds. Right, so I don't want to pick on any certain record keepers or providers out there, but there are some to where what you see normally with an RFP is they're going to put in some of their own proprietary funds, to where that now is potentially a conflict of interest, because more or less we find that compensation is baked into the cake from those. So as long as in that RFP process there's no conflicts of interest in the form of proprietary funds in that example, it would not be considered a recommendation. Marketing of an investment platform that's not individualized, or provider states that they're not providing advice or acting in a fiduciary capacity, right? So in other words, this just means that as long as a service provider doesn't market an investment platform to meet individual needs, then it wouldn't be considered a recommendation, right? So with any firm, obviously you want to generate business, and to do that you have to have some type of marketing effort. What the Department of Labor is saying is, for it not to be a recommendation, it just has to be general in nature, essentially, right? Can't use words like appropriate, right? Because that starts to then kind of funnel down and target specific groups. This investment's appropriate for you, or this plan's appropriate for you. That's when you start to tread, the fine line, if you will, toe the line, if you will, of becoming a recommendation. So as long as the marketing of the investment platform by your record keeper or by your service providers is general in nature, typically it won't be considered a recommendation. And same goes for general information around content that's provided at places like conferences, right? So as professionals, we all go to industry conferences. Presentations there, information there won't typically be considered a recommendation. Same thing with like TV shows or talk show commentary. That's typically not going to be considered a recommendation as it relates to this fiduciary rule. A recommendation of a record keeper. So, they wouldn't be considered, or this wouldn't be considered a recommendation and wouldn't be considered under the realm of fiduciary, again, if no recommendation regarding investment alternatives is considered. So I would say that some of these bullet points have some overlap, and this is where it can become a little bit convoluted, but I would just say, the general takeaway is, as long as everything is objective as opposed to subjective and more general in nature and not individualized, it typically won't be considered a recommendation. There are some ways, which we'll hit on a little bit later on, to where you can start to provide a little bit more of a specialized and tailored approach. But again, there's some caveats that have to be fulfilled and adhered to make sure that you're not violating any of these new regulations. And then last piece, which I think is very, very important, and I think that this is a category that maybe doesn't always get looked at, but investment education, right? So let's talk a little bit more about that. What type of education can be provided, both again to a plan sponsor and then also down to plan participants, that wouldn't be considered a recommendation or wouldn't be considered fiduciary in nature. Again, general plan information that relates around general financial well-being, how the plan works, just general investment and retirement advice, right? So here's what a equity is, here's what a bond or fixed income is, Just again, I can't stress it enough, general in nature. Any type of asset allocation models and not interactive investment tools, again, as long as you keep it general in nature, it won't be considered any type of recommendation or considered a fiduciary type of information that's given. What they can't do, obviously, is to include specific investment recommendations. So myself, if I go out to my clients and meet with participants, I can't start to say, you know what, Mr. Smith, because you're 55 years old and you're getting ready to retire, I'm gonna recommend that you put your money in ABC and XYZ funds, right? Again, without these special kind of stipulations that I'll talk about in a little bit, if I just go out and do that and then advertise myself as not necessarily being a fiduciary, those are two conflicting messages. So again, falls in the same line there. Cannot reference appropriateness, right? That was one of the words I said that typically can't be used regarding investments and distribution options. So the choices that folks have when they either no longer work at the firm or they get ready to retire, you have to be careful as it relates to that guidance. So let's talk a little bit about models and the different tools that are available to plan sponsors and the participants. Again, from our perspective, our firm, we part of what we do is some due diligence on the investments in the plan. That kind of falls under the line of we typically have model portfolios that we provide as an option. So there's a couple different ways that we are able to do that and still maintain our fiduciary status. One of them is, it has oversight. So we act as an independent, what's called a 338 fiduciary. And essentially we have a process in place, and that process isn't just us alone. We involve the plan sponsor, really in all cases, to where there's processes in place to make sure that we are monitoring and maintaining kind of procedures moving forward as it relates to those investments and those asset allocation models. There has to be information about what the DOL calls designated investment alternatives. Just think of that as all the plan investment options, right? So there has to be basically information in the form of what you see, you're probably familiar with nowadays, of all the different disclosures, right? So the 404AB2 fee disclosure, there has to be, again, some type of document or documentation around the fact that participants and plan sponsors are able to go out and identify what other options are out there. That does not include any self-directed brokerage accounts. So we most times run into that with smaller firms, what I'll consider more kind of niche professional firms. So think doctor's offices, law firms, right? They tend to have more use or more access to the self-directed brokerage windows where you can jump out and based on your own terms, without any fiduciary ties, pick and choose what investments you want to put your money into outside of just the normal fund menu. Again, accompanied by statement of similar DIA, so that would again fall under the line of the different notices that are provided or supposed to be provided by law, and location of more information. So normally, if you look on your statement or the information that's provided, it'll talk about you can go out and access this prospectus, right? So the point is that they're just giving you the sponsor and the participants the ability to go out and get more information should you choose to do that. If they don't do that, right, that's where you run into the potential red flag or issue of now we're getting to a point to where these rules are potentially going to cause heartache and heartburn, if you will, for plan sponsors if you're not adhering to providing this information. In this case, that wouldn't be applicable to IRAs. So when I talked about this, it's just really from a qualified retirement plan perspective. So who's primarily affected, right? So I talked about which entities or which service providers are going to be affected by this rule. Well, the big one is going to be really anybody that engages with a plan sponsor. So advisors, so people like me in my position, consultants, but it also includes your record keepers and third-party administrators, right? So in other words, really no one's off the hook. If you're involved at all with a qualified plan and you're providing any type of service and you're engaged in providing that service, most likely you're going to be affected by this rule. It's a risk of covered plans with an investment element. So as you see, traditionally what we think of are 401ks, 403bs, profit sharing plans, defined benefit plans. Interestingly enough, and I've had some clients that are surprised by this. This also includes HSA plans. Okay, just because there's typically an investment component there, what I'll say is it doesn't include health, disability, term insurance, right? So if you're wondering about those, that isn't under this umbrella, just because, again, with those plans, typically there's no investment component. But HSAs are one that most people don't think of, but in fact that is considered or what would be affected by these new rules. And regardless of that, so even if this rule didn't come out and specifically state and tighten down a little bit more on the fiduciary definition, that doesn't alter the existing responsibilities that you have as a plan sponsor, as a service provider. Whether whatever category you fall under that first bar, you have some inherent responsibility, right? Your duty of loyalty from that regard isn't affected. In other words, it doesn't fall below where it's at now. You inherently have responsibilities and duties to, even if this rule wasn't in place, that you have to adhere to make sure that you are in compliance. Okay, so how will the definition affect plan sponsors? Well, for those that are service providers that are currently serving in a fiduciary capacity, not much might change, right? So I go back to the example of a registered investment advisor. For those folks, things may not change much. From my position, folks in my role, there might be a possible move from a traditional broker-dealer engagement, so that's what I'll consider to be more of like a commission-based engagement, to this RIA engagement, which is going to be more fee-based. The reason that is, it's just more transparent, right? So again, there's no right or wrong way to do it, but if you're going to be someone who's in the commission-based space, there's going to be a lot more red tape and regulation that you're going to have to follow to make sure you're compliant. So just for the ease of, from my perspective of ease of doing business, you're going to see a lot more firms start to do what we do and act as that RIA, that registered investment advisor. And again, if you're in that capacity, likely no impact on your services, compensation, or status. So, what I would say that you'll maybe start to see service providers charge a flat fee, a dollar fee, a dollar amount, instead of maybe as an asset charge or a basis point charge. Again, that's just for transparency, making it a little bit more clean. You're starting to see that from my perspective in the industry trend that way, which is a good thing. So for service providers receiving uneven compensation, which again would be things like commissions, as I mentioned, there's going to be more disclosure provided to plan sponsors, right? Which inherently means potentially more work for those plan sponsors that have to get out notices, have to meet those deadlines. So to me, it's a little bit more busy work for you. But if that's the way, if that's the engagement you choose to have with your service provider, understand that for them to be able to act in that capacity, as long as they're following the rules, part of that is they're going to have to provide this disclosure. They're going to have to provide these, pieces of information just to do that. As I mentioned, if someone is going to want to receive uneven compensation, so again, as an example, someone who's in that broker-dealer or commission-based, what I'll call traditional broker type model, they have to comply with this, what's called a best interest contract exemption. I won't go too deep into that, but that's just ERISA's high, standard of care. So where again, they're going to have to provide a lot more disclosure to make sure that they fall within these rules and regulations. Or as I mentioned, they might have to alter their engagement to a level fee, so that's that flat dollar fee, or as an RIA, just from a transparency and a full disclosure standpoint. Plan sponsor fiduciary duty to monitor new fiduciaries. So, a lot of the questions that the Department of Labor got from plan sponsors themselves is, so what does that entail? What, to the extent that we have to monitor what's been going on. It came up to where there was informal comments about plan sponsors having to listen in on participant calls. That's pretty far-fetched, in my opinion. And this rule is too much in its infancy to really, give you some clear-cut guidance on that. Only reason I bring that up is just because it has been brought up by the Department of Labor in their discussions and dealings. Right now, it's not something to where you have to be so involved that you're on participant calls, but just know that, those are the types of things they're talking about. Those are the types of things that they're bringing up and kind of mulling over internally. It's worth monitoring at least from my perspective, it's worth monitoring moving forward, because if that is the case, you can imagine there's going to be a lot of additional work and a lot of additional time and effort that's going to have to be put in. So, again, I just bring that up to kind of put you in a position to where you can kind of see where things are going and what's been talked about, but nothing you have to do now as it relates to, specifically jumping on calls with your participants. So a lot of you obviously will work with record keepers. If you have a plan, you work with a record keeper. They may, as far as whether they consider themselves a fiduciary or not, they may rely on this large exemption, which is basically plans with $50 million or more in assets. Some of these record keepers might rely on this to say that, recommendations that we give are considered fiduciary in nature. Again, that can be up for interpretation, as this rule is still somewhat vague and not necessarily, specific as it relates to that. But you might see record keepers come back and say that, because your plan or the money that we're working with you on is more than 50 million, they may say that any advice or recommendations are considered fiduciary in nature. Another piece is they may rely on what's called a point-in-time fiduciary exemption. And again, I'm not picking on them, but this is an example that's come out, is Fidelity, which is actually the largest record keeper in the industry by like over $1 billion compared to their competition. They've actually come out and stated that they are a point-in-time fiduciary, meaning that at one point in time they were considered a fiduciary, but now with this new rule moving forward, the onus now is on the plan sponsor. They are basically pushing that away from themselves and putting the onus, which you always had the onus as plan sponsor, but now it's more and more to be able to monitor and regulate these service providers. So pretty interesting. I thought that Fidelity, the largest record keeper, took that position. It's obviously a business position, but just some food for thought is, even though a firm is as big as them, you may want to at least kind of make sure you understand what their position is as it relates to this rule. So, and then one of the questions we get is our employees, right, of the plan sponsor. So this means our folks that work at or are part of plan sponsors, are they considered fiduciaries? Typically, no. If they're not receiving a fee, right? So we go back to one of the previous slides is, in order for us to fall under that category, that definition, part of it was we had to receive a fee. So if they're not receiving a fee, employees are not going to be considered fiduciaries, right? So that will most often come down to HR, right? People in the human resources or finance department that are involved with the plan day to day. If they're not receiving any type of fee, they're not going to be considered fiduciaries. Communication regarding plan distribution options to participants. So again, if you provide, as an HR professional, you provide a summary plan description to an employee that asks for it or just in normal protocol, that's not going to be considered a fiduciary action, okay? As long as, again, you're not going out and hiring or yourselves aren't being hired to provide investment advice or licensed to be, providing investment advice and getting a fee. So in general, if you're not receiving a fee and you're just going about normal procedure, specifically and typically in that HR role, you will not be considered a fiduciary. So you don't have to worry about, the 401k police, they're knocking on your door and potentially, providing some type of penalty for that. And then our recommendations about rollovers investment advice. So as I mentioned, yes, right, this isn't, I know we talked a lot about it today, and that was kind of our specific discussion points as it relates to qualified plans, but recommendations about rollovers and distributions are investment advice. So that means, whether to take a rollover or not, so someone who's retired to leave the money in the plan or not, how much to roll over, where to put the rollover funds, that's all going to be considered now investment advice. So, as I close here, just something to keep in mind and what I think maybe moving forward for plan sponsors specifically is, proactively discuss each of the plan's service providers and how they're engaged and how they interact with you as sponsors and what the impact of this rule is going to be on them. Ask whether they're going to be providing some type of updated service agreement or fee disclosure in response to this rule, right? Review your service agreements, determine the impact to participants. So again, as it relates to record keeper, determine if their status or, not them claiming fiduciary status is going to change their services and the engagement. And then, ensure you have, more importantly, I would say this is probably the most important piece, ensure you have a prudent process in place, right? Process and procedure, I can't emphasize that enough. The Department of Labor really looks at that. You could have, the worst funds from a performance perspective, but if you have a process and procedure and documentation in place on why you kept those funds, as opposed to a plan that maybe has better performing funds but no process, you're going to be better off in that first scenario, just because, again, document. Can't emphasize that enough. Make sure these service providers that you're working with provide that documentation and are involving you, moving forward from a monitoring and ongoing perspective. So if I'm going to emphasize anything, that'll be, to make sure you have a prudent process in place and you're documenting all your decisions as it relates to who you work with and what services you're providing. So that ends my presentation. I know that was a lot, but again, as Zach mentioned, feel free to reach out if you have kind of offline or want to get a little bit deeper into some of these particular rules and regulations. I would say that a lot of it is still up in the air and not as tightened down, but part of our job is we're monitoring that, and as any changes happen, we'll be sure to, if you're interested, provide advice and give recommendations.
Yeah, and just to conclude, again, thanks to everybody for listening. Hopefully you were able to take some good information from this, from both Christian and I. Feel free to contact us. Again, our email addresses and phone numbers were on that very first slide. Any questions, concerns, or general comments, we'd love to hear from you. So again, thank you very much for listening in, and enjoy the rest of your day. Thanks.